Hi, I'm Ruban Selvanayagam from Property Solvers. Bridging loans are often marketed as fast, flexible, and powerful tools for property investors. And in the right circumstances, they absolutely are. They allow you to complete within 28 days at auction, they help solve chain breaks, they unlock heavy refurbishment projects and properties that simply won't qualify for mainstream mortgage finance. But bridging finance isn't only about speed, it's about structure, it's about the small print, and most importantly, it's about the exit. Because bridging loans rarely fail at the beginning of the deal, they fail at the end. So in this video, I'm going to break down the real costs, the hidden fees, what happens in default, how enforcement works, and how you should be reading the contract with a fine-tooth comb before signing anything. Let's jump in. When most investors look at bridging, they focus on the headline rate. They'll see something like 0.8% or 1% per month and mentally convert it into the annual equivalent. It sounds expensive but manageable, particularly if the deal margin looks strong on paper. The problem is that the interest rate isn't the only component of the total cost structure. Most bridging facilities charge an arrangement fee of 1 to 2% of the gross loan. On a £400,000 facility, for example, that's £4,000 to £8,000 immediately. Often it's added to the loan, which means that you're also paying interest on that fee. Then there may be an exit fee, sometimes another 1%, payable when you redeem the facility. Add broker fees, which can range from 0.5% to 2%. Add your legal costs, the lender's legal costs, valuation fees, and in refurbishment projects, monitoring surveyor fees. Very quickly, the transaction costs can move well into the 5 figures before you've even properly started the project. Then there's the structure of the interest itself. Many bridging loans allow interest to be rolled up or retained. That means you don't make monthly payments, which feels helpful from a cash flow perspective. But interest is often calculated up front and deducted or capitalised for the agreed term. Some lenders impose minimum interest periods, 3 months or 6 months, even if you redeem earlier. If you haven't read that clause carefully, you could be paying for time you never actually used. And that's before we even talk about default, because this is where bridging finance really becomes unforgiving. If you fail to repay on the agreed redemption date or breach certain loan terms, default interest can apply. That rate can increase materially from 1% per month to 1.5 or even 2%, sometimes compounded daily. Over a few months, that can erode a significant proportion of your projected profit. Most investors assume that if their exit is delayed, they can simply extend the facility, but extensions are not automatic. They involve a fresh valuation, they may even involve new underwriting. They frequently involve additional fees and sometimes a higher rate. If the property is revalued lower than expected, perhaps because the market has softened, your loan-to-value ratio increases. The lender may require a capital reduction before agreeing to extend, and if you can't inject the additional funds, your position may become considerably weaker. And this brings us to the real risk in bridging finance. It isn't the headline rate, it's the refinancing assumption. Many investors use bridging as part of a buy, refurbish, refinance model, or BRR. On paper, it works neatly. You purchase below market value, improve the asset, refinance onto a longer-term mortgage, and recycle your capital. But the refinance depends on variables that are sometimes outside of your control. Revaluations, rental stress testing, lender appetite, market liquidity. If the valuation comes in 10% lower than projected, your leverage increases immediately. If rental stress tests tighten, the mortgage may fall short of what you need to clear the bridge. If yields don't stack as expected, you may need to inject additional equity to complete the refinance. And in a rising market, these risks feel theoretical. In a flat or illiquid market, pretty much like what we have now, they become very real. If the exit fails entirely, meaning you can't refinance or sell within the term, enforcement mechanisms begin to apply. The lender may issue formal default notices. They may appoint Law of Property Act receivers. Receivers act in the lender's interest, not yours. Their mandate is to recover capital efficiently, not maximise your upside. That can mean a quicker, more conservative sale than you would have chosen in the first place. And all of this is clearly set out in the facility agreement, which brings us on to the small print. Before signing any bridging loan, you should read carefully the sections covering events of default, enforcement rights, extension clauses, revaluation provisions, minimum interest periods, and personal guarantees. Personal guarantees are particularly important. Even if you're borrowing for a limited company, lenders frequently require directors to guarantee the facility. That means your liability does not necessarily stop at the property. If enforcement occurs and the sale doesn't clear the balance, the lender may pursue the guarantor. There may also be cross-default clauses linking multiple properties. Early repayment penalties may be structured as minimum interest periods. Monitoring surveying sign-offs may restrict drawdowns during refurbishment. These aren't unusual clauses, they're standard in much of the bridging market, but they materially change your risk profile. One practical step you can take before signing is to run the full facility agreement through AI tools like ChatGPT, Google Gemini, and even Grok. Upload the contract and ask it for a summary of all financial obligations. Ask it to identify default triggers, penalty clauses, extension mechanisms, and lender discretionary powers. Also ask it specifically to highlight clauses that increase cost if repayment is delayed. AI won't replace proper legal advice at this stage, but it will force you to engage with the detail. It can surface red flags, and if you do decide to consult a solicitor, it will make the review more focused and efficient. There's also a behavioural element to bridging that often goes unspoken. Speed creates confidence. When you complete quickly, secure the asset and begin works, it does feel like momentum is on your side. But short-term finance compresses time. Every month that passes has a measurable cost. Every delay, planning approvals, contractor slippage, title queries, refinancing, underwriting, directly eats into your margin. Before entering a bridging arrangement, you should be asking yourself 3 direct questions. If the valuation comes in lower than expected, can I still clear the loan? If refinance criteria tightens, do I still have the liquidity to reduce the balance? If the market stalls for 6 months, can I absorb extension costs without the stress? If those questions feel uncomfortable, that discomfort is useful. It highlights leverage risk. Bridging loans are not inherently dangerous, they're simply unforgiving. They're designed to solve timing problems, not profitability problems. If the deal only works because of speed and not because of underlying fundamentals, caution is required. In tighter credit cycles and flatter markets, exit certainty matters more than acquisition speed. Because in property, liquidity is everything, and short-term finance magnifies whatever the market gives you, whether that's opportunity or pressure. And if you found this video useful, please like and subscribe for more clear data-led property investor insights. Thanks for watching, and I'll see you in the next one.